relationship between banks in general with the Fed, and why is that important? Why is this such a critical path for the recovery of the economy long term?
Well, the Fed is, their goal is to obviously grow the economy, control employment and inflation, and so lowering rates was meant to spur on the economy. The Fed, as part of this process to help our recovery, actually got involved in the interest rates on two sides. They got involved with the short-term rate, the Fed funds rate, and without boring everybody, get involved in this quantitative easing, which is basically buying long-term assets and mortgages and controlling both ends of the curve, believing that lower rates would spur the economy on. The economy certainly has recovered, and now it's a question of how you unwind that to get to what we consider a more normal rate environment. That is a challenge that nobody's ever done. We are in an experiment.
Right.
What the Fed did, the Fed and central governments, central bankers did in this last cycle was an experiment to flood the system with cash and hope that the economy would recover. That part's happened. The economy has recovered. How you take that cash out without creating negatives in the economy, putting us into recession or doing something, is something nobody's figured out yet. And so we talk about the Fed sort of easing rates up a little bit on the short end, and Fed they've raised it a couple different times. They're going to reduce their quantitative easing, and we may see mortgage rates go up, but that's a big fear. If 30-year mortgage rates go up 100 basis points, 1%, what does that do to the housing sector? What does that do to the retail sector? And so there's a big concern as they unwind this experiment how it works. And that is, and the choice on the Fed chairman, I guess is important, but I think at the end of the day, whoever they get is going to be somebody that's going to have to deal with this challenge.